You are listening to WTUZ Radio Podcast. Welcome to WTUZ Radio Podcast. I am your host, Rhonda. And today's update, it is a follow-up actually on cryptocurrency. The Fed Reserve Chairman Jerome Powell issued a speech today. Okay, so this is part of our series, Gateway to a New Economy. So I want you all to pay close attention as their study giving disclosure on what's going on with digital currency and the direction that they are going. Again, this is part of a major reset that is underway. Okay, so you can get this off of the Fed Reserve's website. And this speech was literally released today. He was at a conference in England, so it's going into nighttime there. So this is crypto assets and decentralized finance through a financial stability lens. All right. Recent volatility has exposed serious vulnerabilities in the crypto financial system. While touted as a fundamental break from traditional finance, the crypto financial system turns out to be susceptible to the same risks that are all too familiar from traditional finance, such as leverage, settlement, and maturity and liquidity transformation. As we work to future-proof our financial stability agenda, it is important to ensure that regulatory perimeters encompasses crypto finance, distinguishing responsible innovation from regulatory evasion. New technology often holds the promise of increasing competition in the financial system, reducing transaction costs and settlement times, and channeling investments to productive new uses. But early on, new products and platforms are often fraught with risk, including fraud and manipulation, and it is important and sometimes difficult to distinguish between hype and value. If past innovation cycles are any guide, in order for distributed ledgers, smart contracts, programmability, and digital assets to fulfill their potential to bring competition, efficiency, and speed, it will be essential to address the basic risks that besets all forms of finances. These risks include runs, fire sales, deleveraging, interconnectedness, and contagion, along with fraud, manipulation, and evasion. In addition, it is important to be on the lookout for the possibility of new forms of risk, since many of the technological innovations underpinning the crypto ecosystem are relatively novel. Far from stifling innovation, strong regulatory guardrails will help enable investors and developers to build a resilient digital native financial infrastructure. Strong regulatory guardrails will help banks, payment providers, and financial technology companies improve the customer experience, make settlement faster, reduce costs, and allow for rapid product improvement and customization. We are closely monitoring recent events where risk in the system have crystallized and many crypto investors have suffered losses. Despite significant investor losses, the crypto financial system does not yet appear to be so large or so interconnected with the traditional financial system as to pose a systematic risk. So this is the right time to ensure that like risks are subject to like regulatory outcomes and like disclosures, so as to help investors distinguish between genuine, responsible innovation and the false allure of seemingly easy returns that obscures significant risk. This is the right time to establish which crypto activities are permissible for regulated entities and under what constraints, so that spillovers to the core financial system will remain contained. Okay, so again, just so you all are understanding what they're saying, this is the right time to establish which crypto activities are permissible for regulated entities. Okay? So we didn't heard regulations within these few little paragraphs at least 3 times. Insight from recent turbulence. Several important insights have emerged from the recent turbulence in the crypto finance ecosystem. First, volatility in financial markets has provided information about crypto's performance as an asset class. It was already clear that crypto assets are volatile, and we continue to see wild swings in crypto assets values. The price of Bitcoin has dropped by as much as 75% from its all-time high over the past 7 months. And it has declined almost 60% in 3 months from April through June. Most other prominent crypto assets have experienced even steeper declines over the same period. Contrary to claims that crypto assets are a hedge to inflation or an uncorrelated asset class, crypto assets have plummeted in value and have proved to be highly correlated with risky equities and with risk appetite more generally. Okay, so just again to point out, they're pretty much saying that the crypto market is really moving with the regular stock market exchange. Okay, so they're giving you a clue that they are classifying it so far as high risk assets. Okay. Second, the Terra crash reminds us, I find that interesting that they say the Terra crash. I think that was a coin. I would have to look it up. Second, the Terra crash reminds us how quickly an asset that purports to maintain a stable value relative to fiat currency can become subject to a run. The collapse of Terra and the previous failures of several other, okay, so Terra was a coin. The collapse of Terra and the previous failures of several other unbacked algorithmic stable coins are remnants of classic runs throughout history. New technology and financial engineering cannot by themselves convert risky assets into safe ones. So again, they're setting the stage to tell you why they are going to start heavily regulating crypto or regulating it just like other stocks and asset classes are regulated. Third, crypto platforms are highly vulnerable to deleveraging, fire sales, and contagion risk that are well known from traditional finance, as illustrated by the freeze on withdrawals at some crypto lending platforms and exchanges and the bankruptcy of a prominent crypto hedge fund. Some retail investors have found their accounts frozen and suffered large losses. Large crypto players that use leverage to boost returns are scrambling to monetize their holdings, missing margin calls, and facing possible insolvency. As their distress intensifies, it has become clear that crypto ecosystem is tightly interconnected, as many smaller traders, lenders, and decentralized finance protocols have concentrated exposure to these big players. Finally, we have seen how decentralized lending, which relies on over-collateralization to substitute for intermediation, can serve as a stress amplifier by creating waves of liquidation as prices fall. Same risk, same regulatory outcome. The recent turbulence and losses among retail investors in crypto highlight the urgent need to ensure compliance with existing regulations and to fill any gaps where regulations or enforcement may need to be tailored, for instance, for decentralized protocols and platforms. As we consider how to address the potential future financial stability risk of the evolving crypto financial system, it is important to start with strong. There you go. Now you see how they had to go through all of that to basically say it is important to start with strong, basic regulatory foundations. A good macroprudential framework builds on a solid foundation of microprudential regulation. Future financial resilience will be greatly enhanced if we ensure the regulatory parameters encompasses the crypto financial system and reflects the principle of same risk, same disclosure, and same regulatory outcome. By extending the perimeter and applying like regulatory outcomes and like transparency to like risk, it will enable regulators to more effectively address risk within crypto markets and potential risk posed by crypto markets to the broader financial system. Strong guardrails for safety and soundness, market integrity, and investor and consumer protection will help ensure that new digital financial products, platforms, and activities are based on genuine economic value and not on regulatory evasion, which ultimately leaves investors more exposed than they may appreciate. So with all of that said, they basically, once again, telling you they are going to regulate the crypto digital market like they do the rest of the financial asset classes. Due to the cross-sectorial and cross-border scope of crypto platforms, exchanges, and activities, it is important that regulators work together domestically and internationally to maintain a stable financial system and address regulatory evasion. So that's pretty much saying, come on, international community, we need to get our ends ran on these profits that are being made off of this crypto. Okay? Folks supposed to be paying taxes on this stuff. That's basically what they're saying right there. The same risk, same regulatory outcome principle guides the Financial Stability Board's work on stablecoin, crypto assets, and DeFi. The Basel consultation on the prudential treatment of crypto assets, the work by the International Organization of Securities Commissions, network, the work by federal bank regulatory agencies on the appropriate treatment of crypto activities at U.S. banks, and a host of other international and domestic work. All right. So they pretty much telling y'all across the board, they're going to regulate this. So don't think that you can jump and put your crypto assets internationally. No, That's what they're telling you in this paragraph. This is going to be an international thing. So how crypto started out as being peer-to-peer and anonymous, that's dead. And actually, that's been dead for quite some time when the U.S. government stepped in and started taxing it. Okay, so they demanded that the large platforms, crypto platforms, when you sell, keep track of that and issue statements. All right, and those statements go to you and go to the IRS, and you know what time it is. Now, I'm sure some folks are using other international cryptocurrency platforms to trade assets and cash out and go under the radar. Okay. The token to that is a lot of folks lost a lot of assets to either those smaller platforms shutting down or getting hacked, this, that, and the third. So what they're telling you is there will be no more hiding. So that means any of these platforms, these crypto trading platforms, will be subject to international regulation. And wherever they are participating in trading, those local nations, financial rules and regulations as well. Okay, that's what they're telling you. Okay, so they're going across the board. Basel, International Organization of Securities, U.S. banks, and other international and domestic work. In implementing a same risk, same regulatory outcome principle, we should start by ensuring basic protections are in place for consumers and investors. Retail users should be protected against exploitation, undisclosed conflict of interest, and market manipulation, risk to which they are particularly vulnerable, according to a host of research. Now, those of you that have either played around in the crypto market or follow it, you know, it's been quite a few celebrities that have either created, quote, quote, created their own crypto coin or heavily promoted a crypto coin. And every last one of those cases, those coins went under, or it was riddled with some type of fraud. And most of those cases, these governmental agencies stepped in to start investigation and lawsuits and all of that. Okay. So with this regulation that's coming on board, they're giving you the reasons why they're doing it. Okay. Now I'm going to say this. Make no mistake about it. This is a way to reset from a paper currency to a digital currency. They were always going to do this. Doesn't matter. They were always going to do it. So these events of fraud and the crashes and all of that. Now, my personal opinion, the fraud, it is what it is. It's about folks collecting a quick bag. But the crashes, in my opinion, the markets were purposely ran up in certain coins. Folks got their money and got out. But the overall goal of all of it was to justify why the crypto market needs to be regulated. And this totally takes the steam out of it being anonymous. Okay. So it says, if investors lack these basic protection, these markets will be vulnerable to runs. Second, since trading platforms play a critical role in crypto asset markets, it is important to address non-compliance and any gaps that may exist. We have seen crypto trading platforms and crypto lending firms not only engaged in activities similar to those in traditional finance without comparable regulatory compliance, but also combine activities that are required to be separated in traditional financial markets. For example, some platforms combine market infrastructure and client facilitation with risk-taking businesses like asset creation, proprietary trading, venture capital, and lending. Third, all financial institutions, whether in traditional finance or crypto finance, must comply with the rules designed to combat money laundering and financing of, y'all see that word, ism, and to support economic sanctions. Okay, so in other words, if there's economic sanctions on Russia, you're not supposed to be investing and doing business and all of that jazz. Okay. Now, for those of you that don't know, crypto originally, when it came out, was supposed to be kind of a renegade against the system, against the central bank, to be a peer-to-peer system that was anonymous. Now, what had happened was the very early adopters of it was actually the underworld. So it was literally folks that needed to move money around, i.e. money laundering. And it's just my personal opinion. I don't have no proof of this, none of that. And I am assuming some of those highly secret alphabet boy agencies moving money around as well. Okay. The largest users when crypto first came out, because Bitcoin was the first one, was that audience. Okay. The secondary users were like the nerds that was in technology and some gamers. Okay. All right. So platforms and exchanges should be designed in a manner that facilitates and support compliance with these laws. Permissionless exchange of assets and tools that obscure the source of funds not only facilitate evasion, you ain't ran me my ends on this transaction, but also increase the risk of theft, hacks, and ransom attacks. These risks are particularly prominent in decentralized exchanges that are designed to avoid the use of intermediaries responsible for know your customer identification, and that may require adaptations to ensure compliance at the most foundational layer. Okay. So anybody that are on one of the approved crypto platforms, you know that they go through a heavy verification process. Okay. Now I can't speak to the other ones, but the well-known ones that had already got online to what the financial community was going to require from a regulatory standpoint, if you are on those exchanges, you know the extent that you had to go through for to get your account verified. Finally, it is important to address any regulatory gaps and to adapt existing approaches to novel technologies. While regulatory frameworks clearly apply to DeFi activities, no less than to centralized crypto activities and traditional finance, DeFi protocols may present novel challenges that may require adapting existing approaches. The peer-to-peer nature of these activities, their automated nature, the immutability of code once deployed to the blockchain, the exercise of governance functions through tokens and decentralized autonomous organization, the absence of validated identities, and the dispersion or obfuscation of control may make it challenging to hold intermediaries accountable. So, child, I got to take a sip of water after all that because they went down the list. Basically, what they are saying is this crypto market that y'all thought was going to be anonymous, you can go on head on with that somewhere. We're shutting all of that down. Okay. It is not yet clear that digital native approaches such as building in automated incentives for undertaking governance responsibility are adequate alternatives. Connection to core financial institutions. There are two specific areas that merit heightened attention because of heightened risk of spillovers to the core financial system. Bank involvement in crypto activities and stablecoins. To date, crypto has not become significantly interconnected with the core financial systems to pose broad systematic risk. But it is likely regulators will continue to face calls for supervised banking institutions to play a role in these markets. Bank regulators will need to weigh competing consideration in assessing bank involvement in crypto activities ranging from custody to insurance to customer facilitation. Bank involvement provides an interface where regulators, it's over, y'all. It's over. It's really been over. But this is disclosure that you're not finna have anything anonymous as it's regarding to digital currency. Now they basically saying that they're gonna give banks the authority to know what's going on with your crypto accounts. Okay, so subject to crypto intermediaries that resemble complex bank organization to bank-like regulations, But bringing risk from crypto into the heart of the financial system without the appropriate guardrails could increase the potential for spillover and has uncertain implications for the stability of the system. It is important for banks to engage with beneficial innovation and upgrade capabilities in digital finance, but until there is a strong regulatory framework For crypto finance, bank involvement might further entrench a riskier and less compliant ecosystem. So once again, they're telling you that they're going to regulate it, and it's going to be like any other financial instrument. Private digital currencies and central bank digital currencies. Stable coins represent a second area with a heightened risk of spillover. Currently, stable coins are positioned as the digital native asset that bridges from the crypto financial system to fiat. This role is important because fiat currency is referenced as the unit of account for the crypto financial system. Stable coins are currently the settlement asset of choice on and across crypto platforms, often serving as collateral for lending and trading activity. Baby. Child, let me sip this water. Child, let me tell you what they saying. They basically saying, and those that dabble in crypto, y'all know what they're saying. So let's say, let's use Dogecoin. All right. Let's say you bought a bunch of Dogecoin at when it was below a penny, and it started to rise up. Let's say you bought a lot. Let's say you bought 2,000 fiat money. Okay, so I don't know how many millions in Dogecoin that would be, but nonetheless, you got a lot of them. So when Elon, you was manipulating markets. I already know what you was doing. You was getting you a little bag on the back end. I already know what you was doing. Now, I'm not saying I'm mad at you now. Don't get us wrong. I'm just saying I know what you was doing. So remember when Elon Musk pretty much ran up the coin's value, and I forgot how high Dogecoin got. Smart crypto folk took that and used it to leverage to other crypto coins. Okay. So like going from Dogecoin to Bitcoin, which I don't think you could have done. I think it had to be the other way around, Bitcoin to Dogecoin. But that's my point. So going from coin to coin, trading that way, they can retract that too. That's basically what they're saying. Because what people, I don't know if you all have heard people talk about the Bitcoin millionaires that are literally, I don't think they're doing it now. But when Bitcoin was like at 60,000 a coin, folks that were millionaires based on that, because they were holding so many Bitcoins, they were using their Bitcoin asset as collateral. So they were buying homes, all of that jazz. Oh, they were trying to buy homes. Okay. So that's what they're talking about. They finna track it all. That's what they're saying. Okay. So as highlighting by large recent outflow from the largest stablecoin, Bitcoin, stablecoins pegged to fiat currency are highly vulnerable to runs, Bitcoin. For these reasons, it is vital that stablecoins that purport to be redeemable at par in fiat currency on demand are subject to the types of prudential regulation that limit the risk of runs and payment system vulnerabilities that such private monies have exhibited historically. Well-regulated stablecoins might bring additional competition to payments, but they introduce other risks. There is a risk of fragmentation of stablecoin networks into walled gardens. Conversely, there is a risk that a single dominant stablecoin might emerge, giving the winner-takes-all dynamics in such activities. Indeed, the market is currently highly concentrated among 3 dominant stablecoins, and it risks becoming even more concentrated in the future. Woo, child, who, baby? Which one of them 3 y'all fencing to knock out? This is interesting. The top 3 stable coins account for almost 90% of transactions, and the top 2 of these account for 80% of market capitalization. Given the foundational role of fiat currency, there may be an advantage for future financial stability to having a digital native form of safe central bank money dash a central bank digital currency. Let me take a sip of water and I'm going to roll that again. Given the foundational role of fiat currency, there may be an advantage for future financial stability to have a digital native form of safe central bank money, a central bank digital currency. A digital native form of safe central bank money could enhance stability by providing the neutral, trusted settlement layer in the future crypto financial system. So there is no more being anonymous with crypto. They are already telling you right now that the Fed is going digital. It's going to be highly regulated. A settlement, so meaning when they're talking about settlement, let's remember that means how you're going to cash out your investment. Okay, no different than if you have stocks and you go to sell your stocks to get the cash. You're going to settle in some form of quote, quote, approved currency. All right. A settlement layer with a digital native central bank money could, for instance, facilitate interoperability among well-regulated stablecoins designed for a variety of use cases and enable private sector provision of decentralization, customized and automated financial products. This development would be a natural evolution of the complementary between the public and private sector in payments, ensuring strong public trust in the one-to-one redeemability of commercial banked money and stable coins for safe central bank money. Child. So they're telling you that the Fed is going to go digital. Once again, they're telling you that. Okay? So again, this whole thing, the purpose of this is yet another disclosure to tell you they're going to regulate the crypto markets. And Fed coin, because that's what you'll hear people say, or a central bank coin or a central bank digital coin is coming. Building in risk management and compliance. Crypto and fintech have introduced competition and put the focus on how innovation can help increase inclusion and address other vexing problems in finance today. Slow and costly payments particularly affect lower income households with precarious cash flows who rely on remittances, or miss bills waiting on paychecks. Child, let me go on and sip this water. I already know where they going with this. I must didn't read that paragraph, child. I already know where they going with this. Many hardworking individuals cannot obtain credit to start businesses or to respond to an emergency. But while innovation and competition can reduce costs in finance, some costs are necessary to keep the system safe. Intermediaries earn revenues in exchange for safety, providing important services. Someone must bear the cost of evaluating risk, maintaining resources to support those risks through good times and bad, complying with laws that prevent crime and ism, and serving less sophisticated customers fairly and without exploitation. In the current crypto ecosystem, often no one is bearing these costs. So, when a service appears cheaper or more efficient, it is important to understand whether this benefit is due to genuine innovation or regulatory non-compliance. Okay, so why I had to stop and sip my water. Because right now what they're talking about is, when you go to purchase crypto, you pay a fee. And that's just like with any stock trade. Let's be honest. With any stock trade, you pay a fee for that trade transaction, right? Same when you're selling. So you're paying a fee when you're selling and you're buying. So they're basically saying here that lower income folks, they can't necessarily afford to pay those fees to dabble in the digital market. Now, why I had to stop, gather my pearls, and drink my water is because now this is just my opinion. Okay, this is where I'm pretty sure they're gonna go. That they're going to start issuing government payments and stuff via digital currency. Okay. All right. So that's why I clutch my little pearls. Okay. But this is the excuse that they're using to cut down on the costs and to give folks the opportunity to participate in the market. So as these activities evolve, it is worth considering whether there are new ways to achieve regulatory objectives in the content of new technology. Distributed ledgers, smart contracts, and digital identities may allow new forms of risk management that shift the distribution of costs. Perhaps in a more decentralized financial system, new approaches can be designed to make protocol developers and transaction validators accountable for assuring financial products are safe and compliant. Conclusion. Innovation has the potential to make financial services faster, cheaper, and more inclusive, and to do so in ways that are native to the digital ecosystem. Enabling responsible innovation to flourish will require that the regulatory parameter encompass the crypto financial systems according to the principles of like risk, like regulatory outcome, and that novel risk associated with the new technologies be appropriately addressed. It is important that the foundation for sound regulations of the crypto financial system be established now before the crypto ecosystem becomes so large or interconnected that it might pose risk to the stability of the broader financial system. So there you have it, family. This is crypto assets, decentralized finance through a stable financial stability lens. Okay, so this whoever Vice Chair Brainard, this may not have, so this wasn't Jerome Powell, my bad. This was Vice Chair Brainard at the Bank of England conference. Okay, so let me just make sure, see who old boy is over here thinking. But I don't think it was Jerome Powell that talked about this. I think this was him. Old boy from the UK. Okay, so it's a wrap, fam. It is what it is. You can also check out the sources, because in this article, they're listing the sources. So they not playing with this crypto, fam. They're not playing with this. They're regulating. Anytime you see Basil is involved, Brother Odell, you know we gonna have to get on this and break all this down. We know what time it is. Okay? So there you have it, fam. This is yet again disclosure. This time, this is from the UK side. So my bad. This isn't Jerome Powell. I just assumed since it was coming from the Fed Reserve System. But again, this is Board of Governors. So this is the Vice Chair of the Bank of England. Baby, they ain't playing. This is worldwide, like we told you. We told y'all it was coming. Okay? So this is disclosure. Okay? So I hope you all got some value out of this. We will continue to stay on this and to track at a high level what's going on around the world financially as we are living through a large financial reset. This financial reset, fam, is equivalent to the 1933 reset. That's how big this one is. All right. Now, anybody that rolls with us, you should know when we talk reset on the physical perspective, that is also connected to the spiritual perspective. Okay, because that's the reason they're resetting the physical, because the spiritual or the energy is shifting. So the current of the sea, currency, must also shift with it to the frequency that they want to tune the realm to. Now note, it's not a natural organic frequency, but nonetheless, it is a shift in frequency. All right. So just wanted to put that out there for the fam so you can stay informed. If you are not subscribed to us, I highly encourage you to subscribe, like, and share. I will also leave links in the description of the series that we are doing on Gateway to a New Economy, where we have pretty much broke down how this was going to be laid out. And so far, we're right on target from the inflation, all of that. Okay, so I'll leave that for you all to go back and listen to that as well. All right. So I wish everyone well on this Friday. you have a wonderful day. This is Rhonda with WTUZ Radio Podcast. Peace and love, family.